Hi there, welcome to the Global View on this Friday morning. It's wonderful to be here with you. I'm Nadine Blaney. So let's find out how the setup looks today. So we saw economic data in the United States slowing, which of course increased the chances for rate cuts coming in America sooner rather than later. And that did some good things for the market. You can see the Dow is there up by 0.7%, the S&P 500 up by 0.4%. But the NASDAQ was mildly lower, and that was because we saw some of those big Mag 7 companies weighing on the market overall. Worth to note, the U.S. president was in the UAE pledging to strengthen ties with the Gulf state and signing deals totaling over $200 billion U.S. They also agreed to deepen cooperation in artificial intelligence. Amazon shares, though, fell pretty steeply, down by 2.5% after rival retailer Walmart warned that it will have to start raising prices this month because of the high cost of tariffs. Consumer discretionary was the worst performing sector on the Dow and S&P. Cisco Systems shares lifted, though, after it raised its annual results. Its forecast, at least. It's betting on steady demand from cloud customers driven by the AI boom. Deere & Co., I thought this one was interesting. Its shares were higher after its result beat estimates, but it was warning of softer demand going forward as farmers look to rent tractors instead of buying them. And after surging earlier in the week on index inclusion, Coinbase shares sunk, down more than 7%, after the New York Times reported that the U.S. SEC is investigating whether its user numbers in past disclosures were actually accurate. Oil companies ended up rising, and that's despite we saw oil falling significantly as a potential U.S.-Iran nuclear deal stoked oversupply concerns. So we'll be watching the energy sector here today. In economic news in the U.S., April retail sales slowed sharply as consumers pulled back on spending. There was also payback for consumers front-loading purchases of cars and trucks ahead of those tariffs. Wholesale prices for services like airline tickets and hotel rooms also fell last month, which points to softening economic growth. U.S. weekly jobless claims were unchanged, the U.S. labor market pretty stable. Business inventories barely rose in March, and U.S. manufacturing output fell in April on weak auto production. The Fed Reserve kicked off a two-day framework review with Chair Jerome Powell saying the world has changed since 2020. He said we may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and central banks. On trade, the Asia-Pacific Economic Cooperation Group warned that regional exports will barely grow this year amid the onset of U.S. tariffs as U.S. and Chinese trade representatives met on the sidelines. U.S. 10-year Treasury yields fell sharply, down 7.9 basis points on the disappointing economic data. Currencies were mixed against the U.S. dollar, and the Aussie dipped, sitting currently around 64 U.S. cents. I mentioned oil. It fell sharply, as I said, on those talks between Iran and the United States, and as the IEA tipped supply to rise faster than expected. Brent fell 2% to $65 per barrel. Copper was up 0.6%. Iron ore fell slightly. And gold staged a bit of a comeback, rising 1.8% on the softer dollar and the economic slowdown. Just incidentally, JP Morgan is forecasting a rise in copper and aluminium prices in the second half of the year. We'll be watching the miners here locally as well. Let's get some analysis, though, on that session and some company specifics in the U.S. with Brad Gastwirth, who's joining us from Unearthing Opportunities. Nice to see you, Brad. Thanks for joining us. Look, this week was no exception. Very headline-driven market and a real cooling, I suppose, of some of the big concerns around China and the U.S. Is this a temporary reprieve in your view?
Yeah, it's absolutely the right question, Nadine. It seems like it is temporary. I mean, clearly, if you look at just fundamentals and where we are with this whole artificial intelligence trade, we're still in the very early innings. So there's a huge growth cycle that will continue. However, if the tariff side comes back, which is the big unknown, the markets are going to remain quite volatile. And obviously, we saw quite a snapback quite quickly after the U.S.-China pause. But you're right. I mean, this right now, it's temporary. we have to still find out more details. And there's still some things that are still concerning between the two nations. Most importantly is the rare earth minerals from China, because those go into every semiconductor. And with them, holding back, I mean, that's a big potential problem.
But that will pan out how it's going to pan out. Nobody can sort of guess what's going to happen, as we've all learned. We've all been schooled this year. What we do know is how the markets tend to react. Down one day if there's no news, up the next day on a positive headline on the trade front. And the S&P 500 is pretty much back to where it was to start the year. So where to for markets? Big question, I know.
Yeah. I mean, I think the market's telling us something, right? They want some better tariff news, and the market definitely came back incredibly strong, which is the pause. So, I think Trump certainly pays attention to what markets are doing. I think he cannot ignore the rally that we saw post just the pause. And I wouldn't be surprised if we see a little bit lighter tariff commentary coming from the president, just because of how these markets reacted. Now there's still quite a bit of unknowns, but the market's certainly telling us that it wants to go up. There's a big growth driver with AI, and it's still early innings. And if we do get just at least somewhat of a less daunting tariff side, I think that the downside was already there, and now it's sort of forgotten. And I think people want to buy this market for sure.
Yeah. Okay. So when we think of the implications of some of what we already talked about, you've got to think that with the Fed warning about these longer term supply side shocks. So basically, Jerome Powell was saying that it's quite possible that this becomes some sort of a new norm. Investors need to take note of that. I mean, supply chains are incredibly important when it comes to, well, we just learned with Walmart, for example, today.
Yeah, I mean, I think the new norm has happened even sort of post-COVID. I think the supply chains have been sort of stressed. I mean, prices are still going up as much as the economic data that came out. I mean, if I look here just locally, things are still more expensive, and I don't see inflation easing anytime soon. Because even with the pause on the Chinese side, it's still upward numbers, right? The prices are still going higher. It's just going higher at a lower magnitude. So I think you're going to see inflation certainly tick higher in the coming months. I think it's almost impossible not to see that, and that's a concern. That being said, there's so many positive things from a fundamental standpoint and financially for companies. I mean, we're seeing layoffs. That's a concerning thing for the job market. But companies are becoming more efficient. That means their fundamentals are going to get better. Their numbers are going to get better. Okay.
And it will be earnings that ultimately drive the market to either which way. On the company specifics, we had Dick's Sporting Goods acquiring Foot Locker, $2.4 billion. So clearly some pretty punchy deals are still being done, even in those sectors that relate to the consumer.
Yeah, and I mean, I think I've talked about this a few times on your program. I expected M&A to continue in the Trump administration, and he's making it easier. I think you're going to see M&A continue quite drastically this year and going into next year. I think there's a lot of more of a friendly environment for all companies, and I wouldn't be surprised to see that. Now, there's a big short call on Foot Locker, and you saw that stock obviously got like a 90% premium to the close previously. I think people are going to be scared holding shorts. And I think even after that market rally, post the pause, I think if you're short this market, you have to really wonder, like, what's the negative news that's going to take it down dramatically? And is there more of an upward surprise rather than a downside surprise? And you're absolutely right. I mean, that Foot Locker acquisition by Dick's, I mean, I think there's more to come.
Okay. One thing that's sort of flown under the radar here, but I'd like to get your take, is United Health. So it's facing a Department of Justice criminal probe. I mean, this is a massive company. We all sort of learned about it, sadly, when one of its executives was shot on the streets of New York. But this is a massive company. It is a key defensive holding in many U.S. portfolios, and it was down, I think, 7-8%, extending a really poor run. So what should investors take from that?
Yeah, and a great question here, Nadine. I always get more of a reactive when I hear big negative headlines. So when you have a criminal probe going into United Health, I think you need to at least trim down exposure if you are long or have exposure to that stock. I mean, there's a lot to be known, which is not really available at this current time. But to me, when you get these probes, there's typically more to come. And I think that 7 to 8% first downtick, I think, is just the beginning. I wouldn't be surprised to seeing a further retractment here. But I think yeah, you're right. I mean, on the defensive side, there's a lot within the healthcare that it could be interesting. But in terms of United Health, I think you have to be more concerned with it here in the near term, certainly with this probe going on.
All right. So, Brad, we could talk all day. When we think about how things might happen in the weeks to come, it's really Trump, the headlines, tariffs that you're looking at, and then you're looking for opportunities coming from that. You mentioned rare earths earlier, so you're looking for opportunities in the commodity space at all?
Yeah, so I mean, I'm still quite bullish on precious metals, and I feel like beating that dead horse. I talk about it every time. I think you will continue to see gold and silver rise going into the next several years. It's that one tangible asset class that is really universal globally, that has value, that tangible value. So I think in good times and in bad, I think you will see that asset class or the gold and silver and precious metals go higher. So I think that's a very safe and a good investment here in the near term, and then also on the long-term basis. But I think in terms of stocks, I think you have to have exposure to companies that have just absolutely killed numbers. Like Microsoft reported ridiculous numbers. I mean, they had 30% growth on the cloud side. They talked about really positive things across the board. I mean, this is a 70 billion revenue company growing double digits. And I think companies like that you still need to have exposure to. And I think the ones investing in AI are going to continue to outperform.
Brad, it's always nice to get a chance to speak with you. Have a good evening. We'll see you soon.
Thanks, Nadine.
Brad Gastwirth from Unearthing Opportunities, and he was joining us live from the United States. So a few U.S. corporates to take a look at there. So here's the picture for the open here locally, up by 80 points. That sounds pretty punchy to me, and I spoke with Henry Jennings from Marcus Today just a short time ago. He reckons we'll be lucky if we can keep those gains on the board, but we both agreed we'd love to be surprised on this Friday. With that in mind, that does it for this edition of The Global View. Stick around. We'll bring you that interview with Henry Jennings next.